All right, welcome to the director's cut. Just a couple reminders that I'm going to throw out. We do publish the director's cut both to North Dakota Department of Mineral Resources on YouTube, as well as North Dakota Oil and Gas on Apple Podcast. So if you want to listen back to anything that's discussed in any of the director's cuts this month, or even some of the past ones, you're welcome to go back and listen to that information as well. Otherwise, I'll pass it over to Lynn for this month's production information.
Thank you, Katie. This will probably go fairly quickly, but we're talking February production. And yes, it was still winter. So the conclusion is that we actually saw virtually no change in oil production. It went from 189,000 barrels a day to 1,089,000 barrels a day to 1,089,000 barrels a day. It was, I guess, less than 500 barrels a day of change in oil production. So it remained flat and relatively low. If you recall, this is what happened when on Christmas Eve the weather turned cold and we saw a drop in production below 1.1 million barrels a day. We did return to the previous or prior year's trend, which even though oil production was virtually completely flat, natural gas production went up 1.5%. So we're back with that trend of growing gas oil ratio and production from within the core. Having said all that, the weather was bad. The production not too bad, and the prices were amazing. So we were about 1% below revenue forecast with production volumes on the oil, but February oil price was 74% above revenue forecast, and today's oil price is more than 200%. It's 119% above revenue forecast. So we saw the temporary effects of announcing strategic petroleum reserve releases. Most people in the industry said this is going to be very temporary, and that's correct. It doesn't really correct the long-term issues surrounding Russian sanctions. And if you look at on our page 2 of our director's cut, if you look at U.S. storage volumes, you can see that we're still well below the 5-year average, which typically expands this time of year, well below the 5-year average. And world volumes, storage volumes, are within the 5-year average. So we're in a very tight market situation, and the releases from the strategic petroleum reserves, although they had a temporary effect, and you probably saw that 10 cents in your gasoline price here in Bismarck. So, you know, not to belittle that because it's beneficial for consumers, but that price drop has essentially gone away. And with the news today that Russia is mounting a new offensive in eastern Ukraine, it's just looking more and more like this tight world market situation, and this shift of where oil goes around the world is going to continue. You probably heard that Russia is shifting its exports to the east to focus on India and China and the Asian countries, and that what used to then go to Western Europe and to the Western Hemisphere is going to come from the United States and from the Middle East. So the supply lines surrounding crude oil are shifting as well. Just very quickly, when we look at completions, we were about 33% above revenue forecast. So we had a healthy volume of completions in both February and March. So we're encouraged by that. But there was an article out yesterday that North Dakota is not unique in depleting its duck well count. And of course, ducks are drilled but uncompleted. And so we're seeing that now nationwide. I believe it was Reuters that was reporting on that, or oilprice.com was reporting that we're seeing rapid depletion of the duck well inventories, and rig counts have more or less stabilized around the US. I think Texas is still adding rigs, and we are slowly adding rigs. So when we look at today's rig count, happy to see that that's up at 38. One of those is drilling a carbon storage well, and so it's actually 37 operating in the oil and gas realm, and stable as far as Fort Berthold activity with the 6 rigs running, and 5 of those, I believe, are on trust lands. When we look at gas capture, look better. We were up to 95%, even with that increase in gas oil ratio and the flat oil production. Gas capture grew as people began to work through the weather, winter weather conditions. We do still lag in the fee area of Fort Berthold Reservation, and that I think has to do with some significant downtime that occurred in February at some compressor stations that move gas west across the Missouri River, as well as at the Robinson Lake plant. And we did find out that Robinson Lake is planning a major turnaround now in August. So as we look forward to the month of August, we have to be thinking about that. But they are on track to complete their connection to the state line outrigger plant, or the outrigger plant. I always forget the name. Severson. Huh? Sanderson. Yeah. The Sanderson plant over on the state line, and Justin can talk more about that. But they're going to be able to offload at least 50 million a day to that plant. And it sounds like, based on conversations, that they're going to try to do more than that. Now, Robinson Lake processes 150 million a day. So we're still potentially looking at some significant flaring or shutting in production in the Newtown area as we go into August. We have restarted the litigation with the BLM over lease sales. And so I'm not going to comment in any specifics on that, other than, we're getting that restarted here in federal district court. And of course, you probably saw last night that they announced a sale, and it's essentially a ditto of what was announced before and then canceled. So with that, I don't want to get into much, if any, detail there. Kind of jumping around a little bit here, I just noticed that we do have one new addition to problem fields. It looks like Deepwater Creek Bay has gotten on track with gas capture. They got above the 91%, but forebears fell off and is our lowest at only 54% gas capture, and that has to do with all of that downtime. I'm going to take just a minute and talk about last week. Clearly, a 3-day blizzard has a major impact on an industry like oil and gas. And so with Justin's help, we try to kind of track that in real time as we look a couple of months forward to what we might be seeing when we report April numbers. It looks like about a 25% drop in production due to the blizzard. So at least during the blizzard, we would have dropped below 1 million barrels a day, with probably 25% of our production shut in because of the inability to transport oil and to keep things operating if they went down. And it looks like maybe as of today, a week later, we've recovered about half of that. So we're still down probably 1/8 or 12.5, 13% of our 1.1 million barrels a day. So we may still be this week below 1 million barrels a day. I think the average for April likely will recover to 1 million barrels a day or slightly above, but it's going to be a bad month. And so we'll watch that and keep you posted. But I know we had some inquiries about the blizzard. Impossible to frack wells, impossible to deploy workover crews or workover rigs. Sometimes impossible to actually move the crude oil. And so people implemented automatic shutdowns and shut wells down in order to maintain gas capture and also for safety reasons. I think it's interesting that when we had this occur in 2011, we had some very significant spills because we had tanks overflow. People hadn't implemented automatic shutdowns or remote shutdown devices. Nowadays, most cases, we have that as a permit stipulation if there's any risk associated with the well pad at all. And so we saw very little, less than a handful of incidents with spills. And I think only one that actually got off-site during the entire blizzard. So we've come a long way in 10 years from what it was like in 2011, before we had perimeter berms, before we had remote shutdown or automatic shutdown required. So major impacts in terms of production and certainly revenue as a result of the blizzard. But that is what happens when you live where we have winter. With that, I'd be happy to take a few questions.
Any questions in the room first? I do have one that's come in online. Just given that production didn't exactly drop, do we expect any increase once the weather warms up in the coming months, or kind of how much of an increase may that be?
Great. Thank you for the question. And so, January to February, no, we didn't really see a drop. Now we are expecting a significant impact due to the April blizzard. That's also likely to extend road restrictions. And so it's also likely to delay what we would call recovery. I should have talked a little bit when I was talking about rig count, and so I'll dive off in there. I did have the chance to go to Denver last week and meet with another group of our operators. It's really amazing, at least it was amazing to me to see the impact of the last 3 years on the oil and gas industry in Colorado, or our Denver operators. So 3 years ago, when I was there, I spent 2 full days and actually missed a few folks that I would have liked to stopped in and visited. This time, it was possible to visit essentially the entire Denver, Colorado oil industry in less than 2 days and in 2 office buildings. That's how much it has shrunk. So you used to walk up and down 17th Street and you had to cover, a dozen or so buildings and offices to talk to people in the executive suites. You can now do it in a day and a half in 2 office towers. So there's been a significant shift out of Denver, Colorado by operators to Houston and also the Dallas-Fort Worth area. So we'll be focusing on making visits down there. Having said that, the people we talked to, we pretty much got the same story, that it's difficult to get workforce. It is difficult to get capital. And so they're talking about, again, 1 to 2% production growth, and not really starting that until the 3rd quarter of this year. So adding a few drilling rigs. I think the other interesting piece of information that came out was that all but one of our drilling rig operators has moved 90+% of their iron to the Permian. So the rigs, the actual physical rigs, for the most part, aren't here anymore. And but that one operator has a significant inventory that they could deploy, getting us back out up into the 40s. However, they're finding that they can only hire and train up a crew about every 2 months. So you're looking at 6 rigs a year in a best case scenario that could be added between now and mid 2023. So we're not going to see rapid growth. Everybody's talking basically the same thing. Third quarter of this year, we're going to see some significant increase in activity, but we're looking at 1 or 2% growth. Long answer to a shorter question, but it triggered a lot of thoughts. Thank you.
When you talk to them, do they have any suggestions about finding workforce at this point, or is that the $64,000 question that can't be answered?
Great question. So the question in the room was, what were their answers or suggestions about finding workforce? So they have already increased hourly wages, $10 an hour, and that hasn't flipped the switch. They have gone back to super commuters for frac crews, meaning people that live someplace else and come to North Dakota for 2 weeks to work on a frac crew, which is not the most desirable thing. Actually, they all seem to be very much on board with what we were already thinking, and that is that we are going to have to leverage the Career and Technical Education Academy process that was kicked off with the ARPA funds and is taking place in Dickinson, Watford City, Williston, and Minot, where we're going to actually make an enormous effort to get juniors and seniors in high school to intern, to get the training, and have the capability then of going to work in the oil field the day after they walk across the stage and get their diploma. But pretty much over the long term, the workforce issue is we're going to have to grow our own, and that's the page that everybody is on. So on a temporary basis, we can get people to come back here or move here or super commute to here, but that's not going to add enough workforce to really get into a growth mode. We're going to have to train our North Dakota youth to be our workforce, which in the long run is a positive in every aspect, but it doesn't satisfy the short-term requirements.
Question for you about federal leasing. Just as I was looking through the notice and the various documents that were posted, it looked to me like all of the parcels in North Dakota had stayed the same from what was planned for the Q1 sale.
That'd be correct.
I think it's in Montana though, there must have been some that was cut because it looked to me like the total overall acreage was about half of what was being offered previously. Am I right there?
Yeah, so the question in the room was on the federal leasing thing, and I'll try to stick with the general stuff, was there was a significant reduction in acreage, and where did that occur? And you're right, it was on the Montana side of the line. So the North Dakota parcels was a ditto of what was supposed to be auctioned off last month in North Dakota, and the reduction was a number of Montana parcels that are subject to litigation, and so the greenhouse gas impacts were re-estimated, and a significant number of those parcels were taken off the comment list. So I think now we're into I forget if it's a 30 or 45-day comment period, but the sale is projected to happen in June. Yeah, so.
And can you comment at all just on what, if any, impact this now planned lease sale has on the litigation in North Dakota?
Mm-hmm. Amy asked if I could comment at all on what plans it might have on the litigation. We just started those conversations this morning, so I really can't. But it's our intention to move forward. So.
Question that came in online, kind of going back a little bit to investments in North Dakota. There's been some discussion in other states that privately owned operators will increase their output more quickly than publicly traded companies. Are we seeing that in North Dakota, and can you maybe explain it?
Mhm. Yeah, thank you. So we are seeing that in North Dakota. We have been seeing it. Our privately funded companies, and thanks to Justin for sort of ferreting this out, our privately owned companies have actually gone back to their pre-pandemic drilling levels. So they have fully recovered from the pandemic. The publicly traded companies have not. They're operating at about half of where they were pre-pandemic. So to comment on that, the discussions with the private companies, and one of the biggest ones I didn't get to meet with because of the blizzard and my panic attack and trying to get back to North Dakota, which I may as well have stayed because that didn't work out. But the privately owned companies that we did talk to have been able to fund that out of cash flow. So they have not seen private capital pushing them to up their activity or to grow their production. Their private investors have wanted them to maintain production, not let production drop, and to maintain cash flows. As you might guess, with oil going from in the 50s to over $100 a barrel, the cash flows are very, very strong. And so they've been able to move that cash flow into more activity, more drilling and more fracking. The publicly traded companies, on the other hand, have been expected by their stockholders to pay dividends and buy back stock, buy down debt, and make other investments. And so the pressure on them from where the big capital comes from is very similar, but they have been able to redeploy their cash flow into activity, whereas the publicly traded companies have been expected to pay that back to stockholders.
Kind of a random question about oil prices. Just looking at today's prices, the price for North Dakota light sweet is actually higher than WTI. Isn't that unusual?
That is extremely unusual. I triple checked it because I was like, this just doesn't ever happen. But I think, and you know, Justin, maybe let's make sure we ask him that question, because we are seeing a very unusual situation where Clearbrook is paying significantly more than Cushing, Oklahoma for crude oil. And it's got to be a, you know, sort of a localized supply and demand issue, but I think you're going to see the rail volumes have gone down substantially, and this whole reworking of the world supply chain for crude oil, where is light sweet crude coming from and going to, has pulled more and more crude oil to the Gulf Coast to supply refiners in Europe and in South America. And so yeah, we've seen a flip of what's normal. You know, normal we would see probably a $5 or $6 differential in the other direction. So great question, Amy, and good catch. I was quite surprised by it myself.
Question about prices as far as the tax trigger. I know I think we're still like a month and a half out from actually hitting that trigger if we're going to. Have you heard, is there any chatter about trying to address that trigger, you know, prior to actually hitting it, as far as like legislative action or a special session or something to do that? Or as far as the conversations that you're hearing, do state officials feel like we could wait until 2023 to discuss that?
Mm-hmm. Yeah, so the question in the room was the reverse trigger that North Dakota has built into its extraction tax, and you know, what have the conversations been around that? Interesting that I had the opportunity to ask these operators about it and its potential impact on their plans, and mostly they hadn't given it any thought, which was, I found that kind of interesting that it had gotten, very little thought from any of the oil and gas operators. I've heard a few individuals talk about a need to change that policy. Even some discussions about whether or not a special session might be appropriate. For the most part, I've heard that there's little or no interest in that, and that it may get addressed as part of a larger package in the 23 session, or maybe not, depending on how long these high prices are sustained. So you're right, we're about 6 weeks out. We've got half of the reverse trigger now is behind us, and we know that we've stayed above the 94.69, I think it is, or 94.50 that's required for that reverse trigger. It's greatly going to depend on what this Russian military campaign in eastern Ukraine does to world prices. But so a few little bits and pieces of conversation, Adam, but no real commitment that was something that the politicians wanted to do.
A couple of questions about federal leasing as well. You said one thing I wanted to clarify, how this works in terms of what the administration is doing. Yeah, I think you said some of those Montana parcels were taken off for different various concerns, but some of them being the climate or GHG calculations. How is this is I guess very technical, but how is the administration approaching those climate change implications right now in the wake of that Louisiana decision? Because my understanding was that blocked the way they were calculating it, but are they continuing to calculate some sort of GHG or climate change implication just in a different way than the Louisiana court barred them from doing?
Yeah, great question. So Adam was asking about the federal leasing, and why, like my comment that the Montana parcels were taken off because of climate change impacts. So just kind of in broad generalities, it's my understanding that the court initially said that the Biden administration couldn't use the worldwide impact cost, but I believe there's a later court decision that allowed that to come back. And so now the Department of Interior did a couple of things. One was they increased the royalty rate on all these tracks. So I guess I wasn't exactly on track when I said North Dakota is ditto, because had they been leased before, it would have been at 12.5% royalty, and now it'll be 18.75. So that's a pretty significant change. And then secondly, as you notice nationwide, and I think it was published, only about 20% of the tracks that were planned for leasing prior to this new release are actually out for leasing or published for leasing. And that's all about the climate effects. And so when I read through it, and I'm going to have to dive into this in more detail, but for example, on the North Dakota and Montana tracks, the climate change impacts and the social justice impacts are a major part of the leasing record of decision or analysis that DOI did. So it's a very significant change. The royalty rate changed on the 20% that they are going to lease. 80% of them were taken off either because of climate change or social justice issues. So
just to say the document term following the 80% in the Montana Dakotas region, or
no, that's nationwide.
Oh,
But those same things are what caused. I think Montana's acreage fell by about 50%. About half of the Montana tracts that were expected to be leased in March are now off the table for June, dominantly for the climate change impacts. And you were there in the courtroom. Wild Earth Guardians was there with the Department of Justice, and that's why. Yeah.
Just to make sure I'm tracking on the proportion for the portion that's going up for lease. it looked like it was 50% of the previous total, so that would be including Montana and North Dakota. Am I understanding that right? You said it's 50% has been cut off just on the Montana side, whereas it's basically the same on the.
Yeah, no, you're absolutely right. So I got to take a look here at how much is Montana and how much is North Dakota, because it's an overall 50% reduction. But when you look at, and I'm looking at their total projected acres for the year 2022, but Montana dwarfs North Dakota. I mean, they're projecting less than 2,500 acres total this year for North Dakota, and almost 61,000 acres in Montana. So, but you're right. The overall change from March to June is a 50% reduction in acres, and all of that is on the Montana side. So I can't quite calculate that in my head that quickly, but yeah, it's well more than a 50% reduction in Montana acres, because it's the total lease sale that's down by 50.
Right. Okay. Just one other question on this, the higher royalty rate, do you have any sense from industry of how that's going to affect how they approach this lease sale in June?
Question was about the higher royalty rate and whether I know how that's going to impact the industry, and I really don't. I think that was unexpected, and so I haven't had those discussions with the industry. So I will say this, that the tracks that are ready for lease in North Dakota are prime acreage, and so industry's still going to want them. Whether they'll want to pay less, I can't really say. But.
All right, shift over to Justin.
Thank you for all your questions.
Good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get right into some of the routine production updates from around the region, taking a look at, again, our neighbors to the west and to the south. Real steady production in both of those two states, and so no major influences then on kind of the overall picture of the U.S. Williston Basin. On the slide 3, you did just hear from Lynn that update, really tight numbers between that January and February timeframe, and he had definitely some comments about what we may expect in that March-April timeframe and how that may continue to play out, and I might comment more on that here a little bit later. Taking a look on slide 4 again at those changes, well, as Lynn mentioned, we're starting to see those gas oil ratios get back in line with what we were anticipating. We'll likely continue, or we're fully expecting to continue to see that trend continue to march up in the coming months and years. When we look at slide 5 on how those oil barrels are being marketed, again, we're looking at some comparisons between January and February. When the production is that tight, we typically don't see much changes from a transportation system perspective. But really the only change was a little more visible on slide 6. Slightly more barrels moving on the pipeline network and a pullback on the rail side. It's going to be interesting. I know even last month I started to hint at it a little bit. We start looking at the sanctions on Russian barrels and whether or not we'll see an impact in primarily that March, April, and time frame going forward. Again, we look at the numbers at pad 1. Let's see here, we'll go to pad 1 map here on slide 7. So pad 1 is that East Coast area. Historically, they were averaging around 50,000 barrels of light sweet crude from Russia. And then pad 5 in the other region that was importing right around 90,000 barrels per day on average of a light medium type grade. And so there has been chatter, there's been discussions of whether or not we'll see Bakken start to backfill some of those volumes. Again, the only way to get to those two areas is by rail. There is zero pipeline access to pad 1 and pad 5. So the only way North Dakota could backfill those barrels would be on the rail network. So while we have seen a downward trend in those volumes, we'll keep a real close watch on that going forward and how that might look. One other thing I will mention on the rail numbers, let's go to slide 9, Katie. When we look at volumes and that market share, at least at the beginning of the year here, starting out very, very strong with the barrels heading west. So 90% of those volumes estimated to be going to Pad 5. I may have been incorrect here as of late. We've been talking, it is still primarily that Pacific Northwest. I was able to find some data here just recently that was showing some very small volumes going to the California market as well from North Dakota. So less than 5% of all crude by rail go into that Pad 5 region, going to California. So it's still specifically that Pacific Northwest, but we do have to consider some small volumes continuing to serve that California market as well. When we look at pricing, there was some discussion about that and what's happening around the U.S. We'll just quickly hit on our two major, the Cushing WTI pricing, and then Brent. Again, I show that on the East Coast, but that's typically that waterborne world light barrel price indicator. And so you'll see that, you know, just under $5. We're starting to get to that threshold where if you're north of $5, those rail economics start to look more attractive. And if there is some shortages in different areas, that certainly helps that equation as well. So that will be an interesting dynamic to continue to watch. The discussion about Clearbrook, again, extremely strong pricing in that Clearbrook market, $4.70 as of yesterday's numbers. And in Lynn's report, he had the Flint Hills price from yesterday as well, and Amy had quickly noted that it was higher than the WTI. So again, Flint Hills, their pricing, they're pulling that towards the Minneapolis-St. Paul area, and so they're playing in that Clearbrook marketplace. Other barrels in North Dakota are getting marketed through Cushing, through the U.S. Gulf Coast, and so all of those together kind of wrap into what we would call the average North Dakota price. And so the best we can do now is guess at that, but it has been strong in recent months, and if this pricing structure continues to stay relatively stable, and if we do see a pull to some of those coastal areas for Bakken barrel, that does bode well for pricing here at the wellhead in North Dakota. On the imports, exports, again, no major changes. We're still seeing right near zero exports. So that marketing strategy that we had seen in the past where barrels would be transported north, they may blend with a Canadian barrel. That appears to have cooled down substantially in recent months. And then really good news on slide 12. You heard Lynn talk about some of the statewide numbers on the flaring. Again, 95% capture. And then the breakdown here, the 1% flaring from wells that were not connected to pipeline systems, and then the remaining 4% of flaring from systems that are connected. And so when we look at historically, I widened out this chart because I wanted to go back and see when was the last time, if we've ever seen some of this success, particularly on that blue piece, the flaring from wells that were not connected. It was only one other month where flaring was higher on a percentage basis, but there was, February of 2018 was the last time we were at 1% flaring from unconnected wells. Again, this is a tremendous success. I do work closely with these companies. I know that the effort that they've put in to make this happen, and I see behind the scenes that the efforts that they're doing to try and stay on top of this. I don't think when I speak to those companies, this is definitely a success, but there's targets even above and beyond this that folks are trying to hit. So that is, again, very encouraging as we look at the infrastructure build out. When we look at that 1%, one of the things that we could probably point to on that, we've had a number of months where new wells selling gas has exceeded new wells producing gas. So what that tells us is the gas gathering companies are making connections faster than the wells are being drilled, meaning they're working on that backlog of wells that were unconnected. And so that helps bring that number down. And again, the fact that folks have not slowed down on this front is excellent. When we look at prices, again, this is what you'll see kind of behind the scenes, the EIA, their latest price outlook. Again, they're expecting some weakening in the coming years on that price. And so when we look at activity outlooks and production outlooks, this is, again, one of those things that's behind the scene driving some of those numbers. But even with that price outlook, we still are expecting very, very strong growth on the natural gas side of the world. Oil much flatter, but still some growth, very low single digits in these models. But the gas side, again, because of those gas oil ratios, looking very strong. So when we look at the success that we're talking about today on that 95% capture, it is certainly not something that folks can walk away from and not continue to strive for. So we look at these charts, we look at the outlook options for production, the timing, and there's no days off in staying on top of this issue, because it will continue to be a challenge for many, many years to come. When we look at what's been going on the gas transmission side of the world, slide 18, because of the blizzard, when we talk about production being lost, when North Dakota's oil production is shut in, obviously that impacts the associated natural gas production. So what we saw over the last week is a strong shift of reduction in North Dakota natural gas production and a rapid infill of Canadian volumes coming down the northern border system. And so that is a good thing, because one thing we don't talk about a lot, because typically it's not an issue, but during these cold storm events, obviously the number one priority is safety for everyone, to make sure everyone has their furnaces lit and the heat they need to continue to survive and weather the storm. So that we did not have any disruptions that I'm aware of on any of the gas transmission systems, but we did see a shift in the gas mixtures, which is again was to be expected. But as we see production ramping up again in the coming weeks, we'll likely go back to that trend of less Canadian and more Bakken gas on the northern border system. Continuing to see a leaner gas stream on northern border. For years now, we've talked about what's been happening with the BTU numbers. And again, what's driving this is the natural gas liquids pricing markets are tied much more closely to the crude oil markets. So when crude oil prices are very strong, natural gas liquids prices are strong. And so we're seeing less market incentive or less market push to put ethane primarily on the northern border system. We're trying to strip that out, send it down as a purity product or in Y-grade form, and take a higher value for it rather than just sending it in a methane mixture down the pipeline system. So again, that helps in that discussion on northern border. It helps with physical space on that system, but it's something we'll continue to watch and how that will play into North Dakota's long-term development strategies. So with that, again, I can't say enough great things about the transmission systems, the gas folks. Again, having conversations with them over the last week, folks were stationed where they needed to be. They kept systems operating. So good work to all those folks in the field and the offices. So,
any questions for Justin?
Do you know what our rail volumes fell to? I guess February would be the most recent one.
Right around 120,000, best estimate. Yep.
And do you expect, I guess, where is that oil going? I mean, via pipeline, but do you expect it to be on like Dakota Access or any number of export pipelines?
Oh, I'm sorry. So can you ask that question again?
Yeah, okay, so the oil that is kind of being transferred onto a pipeline that isn't going by rail, maybe as much as it was a couple of months ago, do you anticipate that a lot of that oil is going through Dakota Access or just any variety of export pipelines?
Yep. So the question was, so the shift where we saw some of the barrels getting then back onto the pipelines as opposed to rail, where is it going? It was a mixture from what I'm understanding, right? So pricing was strong just about everywhere. So there's an advantageous situation to get barrels to Clearbrook. Obviously, there's strong pricing there. That would be the Enbridge system. You've got DAPL, strong pricing in the Gulf Coast. The other systems that go down to Cushing, whether that's Butte or Double H. So it was certainly a mixture of all those systems.
Just as a curiosity, what is DAPL carrying right now?
Off the top of my head, it's not at capacity. So the capacity of that system is at 750,000 barrels per day. It is not running at capacity. I'd have to look at some notes, but certainly not at that level. No.
You know, if it's running above the previous capacity.
So the question was, is it running above it? So the previous capacity being right around that 570,000. It's, to my knowledge, closer to that 570 to 650-ish type range. Yeah.
Okay. One question about the blizzard, because I think Glen had said that you've done some of the number crunching on that. Was that 25% drop for, are you measuring over just like a 4-day span there? Or can you say a little bit more about what that calculation was?
Yep, so just taking a look at, again, what's happening out in the field from the transporters, what they're seeing as far as volumes and scheduling. And so it was really, once the blizzard hit and once the roads, you can almost track it, with watching the North Dakota DOT site, right? Once roads started closing up, obviously if folks can't access well sites, the gathering systems, again, even, folks think of the production side, but even the pipeline systems, they have pigging stations and other things that folks need to be able to get to in order to operate safely. And so once you couldn't access key locations, production and volumes had to be shut in. So we're now at the point where access is starting to be restored. And so we're starting to see that trickle back up. When we look historically at big weather events, it does take typically between 1 and 3 weeks to try and kind of recover. And I'm kind of a hobbyist weather watcher, and I don't even want to mention what folks are looking at for this coming weekend. So we'll, if we do get hit with more precipitation in the form of snow, which is targeting Western North Dakota again, we'll keep a close eye on that. That will certainly slow and potentially add more hurdles to that equation.
Right.
You're here to prepare us, not scare us.
Yes.
Sorry.
Yes. Well, thank you, everyone.
Oh,
Thank you, everyone.
Dave had to go there, didn't it? He did.
I won't get too far into the weather. Pretty soon I'll have a green screen behind me.